Dividend Investing for Beginners and Dummies. Written by Giovanni Rigters. Narrated by Alex Reese. Introduction. The biggest selling point that dividends have as a form of financial security is their reliability. Most people don't want to invest in financial securities because they are risk-averse, and the unpredictability of the market can be discouraging for first-time investors. Investing in dividends will ensure that you don't have to invest a lot of cash and wait a long time to see any returns. Instead, what you will get is a steady stream of income. Not just this, but the income that you receive can be reinvested in the market, and you gradually can build a portfolio of different investments to ensure that you aren't susceptible to the fluctuations in the market. The companies you will invest in are also ones with established and highly effective proven business models that ensure that the company will be able to make it through tough times, even in a recession. These are organizations which usually conduct their business worldwide. Many of these dividend-paying companies also have the potential to increase their dividends every year. If you do a little research, you will be able to quantify the steady rise in dividends that these companies have given to their investors. It's also important to remember that when you start investing, you have to make sure that you have some basic knowledge of investment and market functioning, as well as being aware of its terminology. This book will explain the basic idea behind dividends, financial securities, markets, terminology, and procedures for setting up your investment structure. We will also look into the advanced strategies of dividend investing to maximize the returns from your investments using different techniques, tricks, and tips. This book aims to familiarize you with the world of stock market investing and explains how it is a world unto itself and hence follows its own rules. Once you get the basic essence of these markets, you just have to learn about how dividends can play a pivotal part in your investment portfolio. Chapter 1. Dividend Investing. Investing in dividend stocks can be right if you're looking for an investment that provides a regular income. Dividend-paying companies regularly distribute a percentage of their profits to investors. Moreover, many dividend stocks in the US are paying investors a fixed amount every quarter, while other companies increase their payouts over time. Some companies pay dividends, others don't. There are several reasons why a company may choose to pass some of its profits as dividends, and another set of reasons why some companies prefer not to issue dividends and instead use all the earnings for growth. For a stable company with regular earnings that doesn't require reinvestments, dividend payouts can be a good idea because many investors see dividend payouts as an indicator that the company is strong. It is also a sign that the company has positive projections for earnings in the future that makes the stock more enticing. Remember, higher demand for company stock will boost its price. Many investors are looking for a steady income linked with dividends, so they will be more likely to purchase the company's stocks. On the other hand, some companies choose not to issue dividends because of the following reasons. Startup companies that are rapidly growing will not issue dividends because they need to invest as much as possible into their growth. Established companies also choose not to issue dividends if its directors believe it will do a better job of increasing its share price through reinvestment. Some companies temporarily suspend dividends to begin a new project, buy out another company, or repurchase some of their shares. Companies that choose to reinvest all their profits, rather than issuing dividends, may also think about the expensive cost of new stock issuance. To stay away from raising funds through this channel, they decide to keep the profits. The decision to begin paying dividends or to increase a current dividend rate is a huge business decision. Firms that will suddenly cancel or even reduce their current dividend payout could be viewed unfavorably, and the share price may decrease as a result. US companies that historically decided not to pay dividends include Tesla, Amazon, Alphabet, and Facebook. Types of dividends. A dividend is a cash payout issued to shareholders of a company, but there are different types of dividends, some of which don't involve the payment of cash to stockholders. Below are the different types of dividends. 1. Cash dividend. Most dividends are considered as cash dividends in the form of an electronic transfer or check. The value of the cash dividend will be transferred from the company to the stockholders, instead of the former using it for growth or operations. Another effect of the cash dividend is that the recipients of cash dividends should pay tax on the distribution value, which can lower its final amount. However, cash dividends can be beneficial for the investors because it will provide you with regular passive income on your investment, as well as the possible appreciation of your capital investment. Some of the companies that pay cash dividends include KFC, Texas Instruments, Lowe's, and Colgate. 2. Stock dividend. A company can decide to issue stock dividends to its shareholders. Most stock dividends are common stocks. When a company issues less than 25% of the total number of outstanding shares, then the transaction is considered as stock dividends. On the other hand, the transaction is regarded as a stock split if it is in a higher proportion of the outstanding shares. If a company decides to issue a 5% stock dividend, it will increase the number of shares by 5%. If you are a stockholder of this company, you will be entitled to 1 share for every 20 shares you own, while 1 million shares will net 50,000 additional shares. However, this doesn't increase the company's value. If the share price of a company is at $10 per share, the company's value will be at $10 million. After the issuance of the stock dividend, the company's value shall remain the same, but the price will be lower at $9.50 because of the settlement of the stock dividend. One primary advantage of a stock dividend is that you will have a choice. You may either retain your shares and bet that the company will use the cash to increase its share price, or you may choose to sell some of your shares to convert your stocks into cash. Cash dividend versus stock dividend. The cash dividend seems a better choice if you want an automatic reward for placing your investments in specific companies, but this is not always true. It is better for both the shareholder and the company to choose stock dividends at least once a year. A stock dividend is as useful as cash, with the extra advantage of not paying taxes upon receipt. One of the main reasons for issuing stock dividends instead of cash dividends could be that in doing so, a company and its stockholders can establish stronger connection with investors, acquiring more of the company with the extra shares. As long as they are not bundled with a cash option, stock dividends are considered superior to cash dividends to some investors. However, I still prefer cash dividends, because with a cash dividend, I get the option to either reinvest my dividend to purchase more shares in the company, spend my dividend income, or I can take the dividend income and purchase shares in another more profitable company. Number 1. Liquidating dividend. Liquidating dividends are issued when the board of directors of a company decides to return the capital originally paid by stockholders as a dividend. This is usually a negative indicator because it is often paid before the business shuts down. Companies issuing liquidating dividends may choose to pay the bill in one or several installments. U.S. companies are mandated to issue Form 1099-DIV to all its stockholders that contain all the information about the payout. Even with several tax benefits, liquidating dividends may not be enough to cover the initial investment, as the company's fundamental quality may have significantly plummeted. 2. Scrip dividend. Scrip dividends are issued by companies who don't have enough funds to issue dividends anytime soon. This type of dividend is a promissory note to pay stockholders at a specific date. The promissory note creates a note payable and may or may not include interest. 3. Property dividend. Companies may choose to issue the non-monetary dividend as an alternative to stock or cash payment. This type of property dividend may either be shares of a subsidiary organization or any physical assets that the company owns, like real estate, equipment, or inventories. Property dividends are recorded at the market value of the asset distributed. Investors may choose to hold the asset for possible capital gains, but this is usually for the long-term perspective, especially with real estate dividends. This form of payout scheme is less common compared to the cash or stock dividend system. From a corporate perspective, property dividends could be distributed if the main company doesn't have sufficient cash on hand to distribute significant payouts, or it doesn't want to dilute its existing share position. Even though these are considered non-cash dividends, property dividends still have a cash value. How companies pay dividends. Companies usually pay dividends in the form of a check, but some also issue dividends as stock options. The normal process for dividend payment is a check that is often sent to shareholders. But in today's world, if you invest through an online brokerage, you will get your dividend deposited in your account. On the other hand, some companies issue additional shares equivalent to the amount of dividend payout. This alternative is known as dividend reinvestment and is often provided as a dividend payment option by mutual funds and individual companies. Take note that dividends are taxable income, regardless of the form you received them. Dividend reinvestment plans, or DRIPs, provide several benefits to investors. If you want to simply add to your present equity holdings with any added funds from dividend payments, a plan can simplify the process instead of getting the dividend payment in monetary form and then using the money to buy more shares. In-house reinvestment plans are often commission-free because you don't need to pay brokerage fees. This makes it enticing for small investors because commission fees are proportionally bigger for smaller stock purchases. A cool update as of late is that many of today's brokerage firms don't charge you a commission fee anymore to buy or sell shares, giving you extra money to purchase even more stocks. Another advantage of a reinvestment plan is that some companies are offering shareholders the opportunity to buy added shares in cash at a lower price. The price reduction can go between 1 and 10% on top of the additional benefit of waived broker fees. So, you can buy more stock holdings at a discounted price over investors who buy shares in cash through brokerage fees. When to expect dividend payout? If a company decides to issue dividends, stockholders are notified through a press release, and the news will also be reported via major stock quoting services for easier reference. Upon the announcement, a schedule will be set, or a record date, which means all stockholders on this date will be entitled to the payout. The day after the record date is known as X-date, which refers to the date that the stock starts trading ex-dividend. Hence, if you acquire shares on an X-date, you will not be eligible for the payout. Usually, the payable date is 30 days after the record date. When the payable date arrives, the company will deposit the dividends with a depository trust company, DTC. Payouts are then distributed by the DTC to brokerage companies around the globe where stockholders are holding company shares. The brokerage firms will deposit cash payouts to their client accounts or process reinvestment plans upon the instruction of the shareholder. Preferred stocks versus common stocks. Preferred stockholders are usually prioritized when it comes to claiming the company's earnings and assets. This covers the issuance of dividends, wherein preferred shareholders are paid before common stockholders. Advantages of dividend investing. Receiving dividends can be seen like getting an interest on your bank savings. It can be quite nice, but doesn't provide the thrill from betting on the rise and fall of share prices. People love the exhilarating experience, especially when prices are soaring. However, if you are a conservative investor, dividend stocks provide several benefits over investing in non-dividend stocks. Dividend investing is also a slow and steady process of constantly buying more dividend shares and reinvesting your dividends in order to increase your wealth. Chapter 2. Guidelines of Dividend Investments. Dividend investments, just like any other niche, comes with its own set of rules. Think of these rules as shortcuts to avoid making common mistakes. These rules are backed by academic research and principles from some of the world's greatest investors. Mind you, do not think of these rules as infallible, since they will always be an exception. Nevertheless, it is good to integrate these rules into your everyday investment decisions. 1. Always go for quality. A long-term approach to investing is one of the best advantages an investor could ever have. It is a rule to invest in businesses that have stability, profit, and a proven track record of showing growth. Why should you go for a mediocre business, hoping it will turn around, when you can invest in a high-quality business? As a financial rule, you should rank stocks by both their dividend payment history and fundamental performance. 2. The bargain principle. You want to buy companies when they are trading at a discount, but remember, the higher the dividend yield does not always mean that this is better. If a company goes through a bad period, its stock price could drop, which would increase the dividend yield. It's always good to do some additional research on why a company's dividend yield is high, above 5%. In addition to this, Avoid investing in overpriced securities. You should only deal with stocks trading below a decade average historical valuation multiple, which is the average value of stocks calculated over a 10-year period. 3. Always play safe. Avoid businesses that pay out all their income as dividends to shareholders, as this means that the business has no margin of safety, and dividends can be reduced at any time if the company gets into financial trouble. 4. Reinvest your dividends. This is one rule you must never break. The power of reinvesting your dividends cannot be undermined. Putting your dividends back to work can do wonders for your portfolio. What's more, you can make use of reinvestment programs, which often enable you to reinvest your payouts automatically without paying a commission fee. 5. Do not make dividends your only priority. Dividends are an indispensable part of investing. However, dividends are not the almighty metric to abide by. Investors need to pay attention to different fundamentals that are often at play in investments. Fundamentals like profits, short and long-term debt, and earning growths are just a few of the financial metrics you need to pay attention to. Remember to look beyond dividend yields and make sure you understand the company's growth pattern and business model. 6. Always look out for special dividends. One of the perks of dividend investments is the ability of corporations to initiate a one-time dividend payout. When looking for stocks to purchase, these one-time dividend payouts often mislead investors. During one-time dividend payments, a company's stock might seem rosier than normal. A good example is Microsoft, MSFT, which issued a one-time dividend payment in 2004. It was a sharp contrast to the normal dividend payouts. Microsoft's normal dividend payouts varied from 30 cents to 50 cents, while the one-time dividend payout was at $3 per share. Many resources calculate the one-time dividend payment as an annual yield. If we were to include the special dividend payout, Microsoft's annual yield for 2004 would have been 13.78% instead of the 0.38% payout from normal dividends. As you can see, the figure was enough to confuse investors who had not checked and analyzed the yield statistics. 7. Use the survival of the fittest principle. Sell your stocks when your dividend payouts are reduced or cut short. It's that simple. Research carried out between 1972 and 2017 showed that stocks that cut or reduced their dividend payouts had a 0% recovery. If your dividends are reduced or stopped, this goes against the principles of generating passive income. It is the opposite of what we are aiming for. Any business that cuts its dividends has potentially lost its competitive advantage. Therefore, you want to reinvest the proceeds of your sale into a more profitable blue-chip company. It's very important to remember this rule. You do not want to fall in love with the company because you use its products daily or you have a good feeling about the company. Chapter 3. Using funds to invest. One main thing that is required is for you to diversify your investment portfolio. That is because diversification protects you from the inevitable downturns that one or more stocks in your portfolio are going to experience. So, imagine that you have a portfolio with 5 stocks in it. If 2 of them go under, that means you have lost a substantial portion of your investment. On the other hand, if you had 20 to 40 stocks and 2 went down, you can see that the overall consequences to your portfolio would have been minimized. Having a widely diversified portfolio means that most of your investments will come out intact, and some of them will grow more than others, which would make up for any losses you might incur. But as we mentioned, there is a limit to what the human mind can handle unless you become a professional investor. Most investors are not going to have the ability to work full-time on managing their stock portfolio. And as we also mentioned, as a result of this, most experts feel that having maybe 20 stocks is the maximum that an individual investor should keep in their portfolio. However, there is another way to approach investing. This is through the use of funds. There are 2 basic types of funds that you can use. These are mutual funds and exchange-traded funds. Our preference is for exchange-traded funds for reasons that will become clear as we go through the chapter. However, mutual funds came first, so we will explain the concept of a fund using mutual funds before we get to exchange-traded funds. Either way, the main benefit of using funds for investing is that you get automatic diversity. Some funds track major stock indexes, but there are all kinds of funds that track everything from metals to real estate to energy. It's entirely possible to build up a nicely diversified portfolio that focuses on multiple sectors of the economy and gives you investments in multiple stocks. Of course, many people enjoy picking individual stocks to invest in. But once again, there are no either-or scenarios when it comes to investing. Just because you're investing in funds doesn't mean that you can't devote some of your investment money to picking individual stocks. The way that your portfolio is ultimately set up is going to be a personal choice. When we start looking at some of the available exchange-traded funds, you will see that many of them are suitable for reaching the goals you probably have when it comes to dividend investing. Therefore, the details of how your portfolio is set up are going to be entirely up to you. Some people may choose to go entirely with funds, while others won't like the style and stick with picking individual stocks. But there is a possibility of having both in your investment portfolio. So you can devote, say, 40% of your portfolio to individual stocks and devote 60% to exchange-traded funds of various types. Or instead, you may devote 70% in individual stocks and 30% to exchange-traded funds. There is no right answer to this question, and you will have to decide how to set this up, depending on how much risk you want to put in individual stocks, or how risk-averse you are and more likely to choose fund-type investing. Mutual funds. So, what is a fund? Let's imagine an investor named Bob. Let's say Bob got a brilliant idea when he was trying to invest in stocks. It occurred to Bob that one of the best ways to invest in the market would be to invest in all 500 companies of the S&P 500. Bob tries to do this buying one share at a time. Pretty soon, he realized that for one investor, this was simply an impossible task. He couldn't come up with enough capital to do it. So, what was the idea that Bob came up with? Bob realized that he could approach 10 of his friends and suggest that they pool their money together into a fund. That way, Bob would have 10 times the buying power than he would have by himself. Let's say that Bob's friends put in $1 million each to create this fund. Now, Bob has $11 million, including his portion, to invest in the 500 stocks that make up the S&P 500. In return for their investments, Bob followed the model of a company issuing stock. So, he divided up the $11 million into pieces that he called units. He was careless with his language, so sometimes he called them shares, thinking about the stock market in general. Then, he made each share for the unit worth $100. So, for his friends to put $1 million, he gave them 10,000 shares in the fund. He said it was mutual, since the fund was put together for the benefit of all the investors, and thus Bob invented the mutual fund. Each night, Bob would buy and sell shares to keep the fund as profitable as possible. Bob started getting more sophisticated in his approach. He thought that by rebalancing his investments to emphasize growth stocks, he could make this fund grow at a faster rate each year comparable to the S&P 500 growth. To be compensated for this extra work that he was putting in, Bob charged his investors a small fee. Of course, the story is fictitious, but it gives you a basic idea of what a mutual fund is. It is simply a pooled amount of money collected from multiple investors. Of course, a real mutual fund is going to have a lot more money than just $10 million, but the concept is the same. Types of mutual funds. Mutual funds don't have to invest in stocks. There's many types of mutual funds. Stock funds are the most common or well-known types of mutual funds. Within the category of stock funds, there is a wide range of options available. So, for example, you can invest in mutual funds that focus only on growth stocks. The goal of such a fund would be to get financial gains via capital appreciation that beat the market average. Other funds may specialize in different industries, segments, or sectors. One of the most popular types of mutual funds is those that track a stock market index. Just like in our example above, there are many mutual funds and exchange-traded funds that track the S&P 500. You can also find funds that track the Dow Jones Industrial Average, Nasdaq, or the Russell 3000. Some mutual funds only invest in stocks that pay dividends, but as we will see later, many different types of funds will pay dividends. There are other types of investments that can be made through mutual funds and by using exchange-traded funds. For example, you can invest in a money market fund, which might be a mixture of investments in US government bonds, municipal bonds, and banking investments. Bond mutual funds will invest in different types of corporate bonds. These may be of higher risk, but they pay higher interest rates. The risk going to the individual investor is going to be relatively low. This is because each fund is going to invest in hundreds or thousands of individual securities. Mutual funds tend to be professionally managed. A fund manager is going to pick the securities that are in each fund. As time goes on, the fund manager may buy and sell shares as they see fit to try and keep the fund performing at a high level. Some people don't want to get too deeply involved in the stock market. For instance, the mutual fund is professionally managed. The way they see it, they can avoid getting too deeply involved in investing. For whatever reason, they may not want to be actively involved in managing their stocks and other investments. However, mutual funds have many downsides. One of the downsides is that this professional management comes with a price. Many mutual funds charge a large number of fees that can add up over time and cut into your profits. Another downside of mutual funds is that they only trade once a day after the market close. So, if you see a big move in the stock market, whether it's a big uptick in price or a meltdown, when you are in a mutual fund, you cannot respond to that big change until after market close. Of course, you can call in your order or place it online, but it's not going to execute until after the market is closed. Some mutual funds also charged expensive fees called loads. What this amounts to is you are charged a commission every time you purchase or sell shares. Therefore, to use a specific example, if you invested thousands of dollars in a mutual fund, but it had a 5% load, that would mean that you would only be putting $950 into your investment, while the fund would take $50 off the top as a fee. Honestly, this is hard to swallow in today's world. You can find an exchange-traded fund that will track nearly the same investments as any mutual fund, and you can buy shares of the exchange-traded fund with zero commissions charged by the brokerage. One brokerage to charge zero commissions on all exchange-traded funds is Robinhood. There are also some others that you can look into. If you dig around mutual funds, you will see that Salm advertises themselves as no-load funds. These types of mutual funds don't charge the sales fee known as the load. However, these funds may still charge other fees. Funds that charge a load may charge fees on top of the load. When you research mutual funds, you can look up all the fees that they charge, which must be disclosed in the prospectus. Almost no-load mutual funds are going to have specific requirements for you to invest. For example, they might require that you keep your money in the fund for a specified number of years. Mutual funds may also have requirements for an initial amount invested. Consequently, this could preclude small investors who are just starting from getting involved with mutual funds. Therefore, to summarize, mutual funds have several benefits. These include strong diversification and exposure to many different sectors. Mutual funds also allow you to invest in multiple types of financial securities, such as bonds. However, mutual funds have lots of downsides. The main downsides include having to wait until after market close to trade shares and lots of fees and sales commissions. You may also face the problem of having to invest a minimum amount of capital to get started. Exchange-traded fund. Of course, many people notice the downsides of mutual funds through the years, so it's no surprise that some people thought of taking the good characteristics of mutual funds and creating a different type of fund that got rid of the downsides. This was the birth of the exchange-traded fund. The first thing to consider is the weakness of mutual funds caused by the fact that they are not traded during the day. Imagine that the stock market suddenly had a rally. You might want to get in on more shares. Alternatively, the stock market might be crashing, and at 10 a.m., you decide you want to get out. The problem is that with a mutual fund, your orders will not be taken care of until after the market close, and who knows how much money you might miss out on or lose as a result of the time delay. The first change made was to create a fund that was set up in the same way as a mutual fund in that it was very diverse. However, the exchange-traded fund, as the name suggests, is traded in real time on the stock markets. While an exchange-traded fund cannot be said to be stock because it's not an investment in a single company, exchange-traded funds offer shares traded exactly like stocks. These are listed on the stock market exchange with a ticker, and you can buy and sell as many shares that you want, and you can do it when you want. That is, you can trade during these times that the market is open. Another benefit is that exchange-traded funds have no minimum investment required other than the price required to buy at least one share. While some mutual funds might require you to put in $5,000 just to enter the door, if you only wanted to spend $85 to buy into an exchange-traded fund by purchasing a single share, you could do that. And 2 hours later, if you are tired of it or think you made a mistake, you could sell that share. Exchange-traded funds also dispense with all the fees that are associated with mutual funds. There may be some small amount of fees that are charged, but frankly, they're tiny compared to those charged by mutual funds. So, trading exchange-traded funds boils down to something that isn't all that different than trading shares of Facebook or Apple. If you invest $1,000, you are going to be investing $1,000. It's not going to be like a loaded mutual fund that takes a fee off the top. And, as we've noted, since exchange-traded funds are traded like stocks, if there is a large market move during the day, you can take full advantage of it. You can also buy options against exchange-traded funds and trade them. Options are beyond this book's scope, so we are not going to discuss the details, but some of the most popular options are options traded on exchange-traded funds. ETFs have diversification. As far as the way the investments are made, exchange-traded funds are quite similar to mutual funds. A large amount of money is pulled together and used to purchase shares of a stock. If you were to buy shares in an exchange-traded fund that tracks the S&P 500, you would be buying stock in all 500 companies. An exchange-traded fund can do this because they have a large pool of money collected from thousands or more investors. Some of the most popular and highly traded financial instruments today are exchange-traded funds. The first exchange-traded funds came on the market roughly 30 years ago. Since that time, they have exploded in popularity and the number of available funds. Anything that you could think of investing in has an exchange-traded fund associated with it. So, there are exchange-traded funds that track all the major stock indexes. There are exchange-traded funds that track precious metals, and you can also invest in funds that track real estate, energy, commercial real estate, healthcare sector, and many other areas. For dividend and investing, exchange-traded funds make an excellent addition to your portfolio. It would be completely reasonable to only invest in exchange-traded funds. Or, as we mentioned in the introduction, you could develop a broad portfolio that was some mixture of exchange-traded funds and individual stocks. But when you start investigating this, you are going to find out that many exchange-traded funds pay dividends. What happens is, they will collect dividends from all the investments of the fund, and then you as an investor will be paid a dividend payment that is in proportion to your share in the fund. In many index funds, the yield may not be quite as high as it is with some individual stocks. However, it's still going to be relatively competitive, and you can invest in many index funds that have yields that are similar to those seen by Apple. We just mentioned Apple again to use it as an example. However, unlike investing in Apple by itself, when you invest in exchange-traded funds, you are investing in hundreds of companies at once. When you buy a share of the exchange-traded fund, you are buying a tiny fraction of the share of some of the companies that are represented by the fund. Another advantage that exchange-traded funds have concerning mutual funds is higher liquidity. Mutual funds are relatively liquid. You can sell your shares and cash out, usually later in the day. However, remember that you can only trade mutual funds after the trading day has ended. In contrast, since you can trade exchange-traded funds at any time, that means that exchange-traded funds are super liquid. You can even day trade exchange-traded funds. Using ETFs to earn income from non-stock securities. Exchange-traded funds are like mutual funds in that you can use them to invest in practically anything. So, when you start digging around, you're going to find that exchange-traded funds are available for a given stock or index. You are also going to notice that you can invest in gold or gold mining, or you can invest in high-yield bonds, for example. The possibilities are quite endless, and for this reason, a lot of people only invest in exchange-traded funds. Dividend-paying ETFs. Many ETFs pay dividends. The way this is handled is that the ETF collects all the dividends from dividend-paying stocks in the fund, and then it divides those up on a per-share basis. So, let us imagine that we had a simple exchange-traded fund with 100 stocks in the fund. Furthermore, for simplicity, we will imagine that there are 100 shares of stock in the fund. Chapter 4. Benefits of Dividends Investment. Below are some of the reasons why it is beneficial for investors to choose dividend stocks. 1. Passive income. Dividends from stocks can provide you with a regular flow of passive income, and you may choose to reinvest or spend them. This is the main benefit that attracts many retirees who are looking for supplemental income. 2. Lower risk. Dividend stocks have less volatility in share price, and they usually have a lower risk-to-reward ratio. Because of these benefits, dividend stocks can experience a less aggressive decline in the share price during a market downturn. Lower volatility can also temper the appreciation of the share price during the market recovery. 3. More stable companies. More stable blue-chip companies often pay dividend stocks. Startup companies usually don't pay dividends as they will need to reinvest most of their profits to sustain growth. As they need to reinvest most of their profits to sustain growth. The board of directors will decide to pay dividends only when the company has achieved a sustainable level of success. Meanwhile, the need to distribute dividends will compel the management to be more responsible. 4. Hedge against inflation. Inflation is the main enemy of earnings from stock investments. A moderate inflation rate could take a huge bite out of your profits. Even if you earn a 10% return, a 3% inflation can result in only 7% earnings. Dividends can offset this loss. As companies increase their prices because of inflation, they will earn more money and pay higher dividends. 5. Baby boomer boost. The price for dividend stocks could go up as the demand for it will increase because of baby boomers reaching retirement and seeking sources of supplemental income. While this is somewhat of a lofty projection, it is still a projection, and there's no guarantee that this will happen. However, the probability of this happening is much higher. 6. Positive returns in bear markets. Companies that pay dividends will still pay their dues even in bear markets when share prices are dropping or flat. The dividends can help offset any loss from a fall in share prices. 7. 2 ways to make a profit. The returns from the dividend stocks could increase when companies pay dividends and increase share prices. The only way you can earn positive returns from non-dividend stocks is via appreciation of share price, buying low and selling high, or short selling. 8. Cash to purchase more shares. If you buy shares in a non-dividend paying company, you can only get more shares if you buy them with your earned income. If you invest in dividend stocks, however, you can buy additional shares through reinvesting all or some of your dividends. There is no need to use the money in your pocket to buy more shares. Most investors are also enrolled in special programs, which allow them to reinvest their dividends automatically. 9. Ownership retention and profit collection. Among the most disappointing aspects of owning shares of non-dividend stock is that all of your profits are locked in the investment. You can only access your profits by selling some of your shares. Through dividend stocks, you can retain ownership of the company while still collecting your returns. While dividend stocks pose less risk than non-dividend stocks, they also carry some risk and may not be suitable for all types of investors. Aside from the benefits, you should also understand the drawbacks of dividend investing. This will help you decide if this type of stock market investment is right for you. Each time you sign an investment agreement with an intermediary, such as a mutual fund manager or a broker, you would usually read a lengthy disclaimer about the results not guaranteed. To put this simply, you may earn money from your investments today, but there is no certainty that it will be the same case tomorrow. Like any other kind of investment, dividend investing also carries some risk. Disadvantages of dividend investing. 1. High dividend payout risk. Investing in stocks with a high dividend payout ratio comes with a risk. Take note that the company's dividend payout ratio reflects how much of its profits are used to reinvest in growth, pay its debts, serve as cash reserve, versus how much is being paid to shareholders. It can be a delicate balancing act for most companies to figure out the percentage of its profits to allocate for dividends. They surely like to entice and retain investors with high payouts, but also need to keep enough of their earnings to support further growth, and, at the same time, maintain their capacity to raise the dividend in the future. In reality, once the dividend payout ratio of a company becomes too high for sustainability, this can force the business to reduce or cancel payouts altogether. 2. Dividend policy changes. Dividend policy refers to the company's plan for figuring out its amount for dividends and any possible increases based on projected earnings. Once a company makes changes to the policy, specifically those that result in reducing or cancelling payouts, it will hurt its share price. Based on the clientele effect theory, the price of a stock is strongly connected to investor reaction to the company's policy changes. So, when these changes happen, many investors will sell their company shares. When a company is forced to cancel its dividends for any reason, you may lose your passive income. 3. Double taxation. Another disadvantage of investing in dividend stocks is that the payouts are subject to double taxation. First, you need to pay tax when you receive your payouts because the company issuing the dividends from its net profit has to pay tax on its yearly earnings. These earnings generate the dividend payments of the company. Second, you need to pay tax again, as you receive the payouts as personal income that you have earned over a certain tax year. Therefore, you are paying tax twice as an individual and as part owner of a company. In general, dividend investing is less risky compared to non-dividend stock investing. However, before you can maximize the returns from this type of investment, you need to be very familiar with both the benefits and drawbacks before you buy your first shares. Managing risks in dividend investing. There is always a risk in stock market investing due in part to its unpredictable and variable nature. That being said, several factors can increase risk. Some are within your control and some are not. Even though we cannot eliminate the risk, it is still possible to minimize our exposure by becoming more aware of the factors that influence market behavior. As a savvy investor, you can manage the risks in dividend investing by dealing with factors that you can control. 1. Diversifying your investments. You must never invest all your money in one company's stock, regardless of how promising the business is. Its competitors may dominate the market, the management may be corrupt or incompetent, or the firm or its whole industry may lose the favor of investors for any reason. These are beyond your control. The good thing is that you have absolute control over where you want to pour your money. You can greatly minimize the risk by spreading your stock investments in different stocks. 2. Minimize human error. Human error is the largest risk factor with dividend investing, and it may result from the following: lack of knowledge, a misaligned investment strategy and investment goals, insufficient research and analysis, using emotions over logic in choosing stocks, failure to keep track of market conditions, allowing panic and fear to influence investment decisions. Doing your due diligence is the best way to eliminate human error. You certainly know the risk involved in not being prepared if you have taken an exam you have not studied for. Aside from the unsettling feeling of not knowing the right answers, you will experience panic that will not help your situation. 3. Use reason over emotion. The efficient market hypothesis is one of the prevailing theories about the mechanics behind the stock market. This hypothesis describes investors as logical people capable of understanding all available information in the market to make reasonable decisions for maximum profits. However, most people are not logical or rational. Many investors are buying stocks based on advice from their family or friends, and sometimes from people they don't know. Some investors buy or sell their stocks because of what they heard over the news or because a new company is making a product they adore and they are sure that it will be a big hit in the market. They know nothing about the history of the stock, its management, or the company as a whole. To effectively manage the risks in dividend investing, it is best to avoid these three major emotions: love, fear, and greed. Love. You must never fall in love with your investments. Remember, these are lifeless assets that are not capable of loving you back. But interestingly, they can betray you and hurt you. Some investors are so in love with the company that they hold stocks in that they refuse to sell even when indicators show that the company's inherent value has deteriorated and the share price is falling. You need to bail out when a stock declines sharply. Review your stocks regularly and scrutinize each investment on its recent performance. If it does not contribute to your portfolio's growth, you can sell your shares, which you can easily do because stocks are very liquid. Fear. Investors who experience losing money in the stock market are susceptible to fear that paralyzes them from taking any action. Rather than taking on some risk with high potential investments, they would rather put their money in safe investments with low rates of return. Greed. Greed is the opposite of fear. Most investors who have made much money in the stock market would usually want more. Some investors are vulnerable to the bandwagon effect, pouring their money into the hottest companies and industries. Greedy investors usually tend to invest in instruments they don't fully understand and then fall into the trap of increasing their investments to try and recover their losses. Chapter 5. Preparation and Planning for Dividends Investment. Getting ready to start investing requires a certain mindset. You need to make sure that you mentally prepare yourself to be ready to invest in the right opportunity and to choose the right dividend investment for your portfolio. For example, you cannot just go into it thinking that you are going to make tons of money right from the start. Dividend investing is an investment strategy that focuses on the long-term approach of buying and holding assets, in this case shares of stocks, which will allow you to grow your wealth one step at a time. Dividend investing is not a get-rich-quick strategy, but it provides stability and a constant increase of your dividend income. Many diligent dividend investors who stick with their strategy are able to achieve their goal of living off of their passive income through dividend payments. Outlook. Always have a positive outlook when investing. Keep in mind that you will make mistakes. Making mistakes happens to the best of us. It's how you bounce back from your mistakes which will determine a successful outcome when investing. Mistakes need to be looked at as a learning or teachable moment. Learn from your mistakes and try not to make the same mistakes again. One major mistake many dividend investors make is just paying attention to a high dividend yielding company and not researching why it is so high for this company. A high dividend yield might not necessarily mean that anything bad is going on with the company, but that's why further investigation needs to be done. Goals. Have goals for your passive income and your dividend investment. Know what you want to make in dividend income, how comfortable you want to be, and whether you want to make this a full-time career. If you set goals for yourself when it comes to dividend investing, you can then break those goals down and figure out exactly how much you need to invest in order to get $1,000, $10,000, or even more per month in dividend income. It's perfectly fine if you have to change your goals. Unexpected things always happen in life, but make sure you hold yourself accountable to the goals you have set for yourself by evaluating them frequently and seeing if you are on the correct path to hitting them. Grow and maintain your income. Growing your wealth with passive income and maintaining it are two different stories. This may be the trickiest part of dividend investing, and it is often the part where everyone slips up and loses the money that they have made. It is best that you are prepared for your passive income. Point 1. Save it. The easiest thing that you can do with the income that you get is to save it. It is a good idea to try to save as much as 50% of what you make from passive income. Save this money so that you will have it later on if an emergency happens. Having some money saved also provides you with some peace of mind. However, saving too much money is not recommended as this could have been invested to grow your wealth. A good rule of thumb is to save between 3 to 6 months of earned income. Point 2. High interest. A good way to save your money is to find a high-interest savings account. This can be from your bank, online, or even a CD that will make you more money. The best thing about high-interest savings accounts is that they are yet another form of passive income. You do not have to do anything other than put your money in this account. Now, granted, you might only make 1% or less in interest from your savings account, but this money is liquid, allowing you to withdraw it at a moment's notice. Point 3. Spend it. If you have a plan or budget in place to spend your dividend income, you will be less likely to spend it on things that you do not need. If you give yourself a set amount of money, you will be less likely to spend recklessly and make purchases that you may regret later on, after you have run out of money from your dividend check. It may seem counterintuitive, but you can even put aside money that you can waste on things that you do not want. This is blow money that you can spend on anything, from new high heels to a gallon of ice cream at the grocery store. The money is yours to use as you see fit, and it will help you to budget it. You will find that the more money you make, the harder it is to budget. Keep a 10% rule for your blow money to make sure you do not get out of hand with it. This will help to keep your spending in check. Point 4. Invest it. Reinvesting the money you have made from your initial investment is one of the easiest ways to grow the wealth you have already made from dividend investing. There's 2 ways to approach this. You can reinvest your dividend income to buy more shares in the same companies, also called DRIP, or you can invest your dividend income into new companies you do not have in your portfolio yet. Point 5. Try new things. If you have money that you want to use and invest, but you do not want to do any more dividend investing, you can always try out a different type of investment. Trying out an index fund will be an excellent way for you to make the most amount of money on top of what you have already made. You may also consider something like a REIT. Switching it up and trying something different can change the portfolio that you have and give you the variety that you need to make sure that your portfolio is diversified. You could also try a different asset class, such as real estate. As always, make sure that you do your due diligence before jumping into a new venture. Chapter 6. Long-Term Investment Strategies. Let's discuss the strategies that are useful for long-term investment success. These strategies are well known and have been proven time and time again to be effective. The purpose of these strategies is to lower the inevitable risk that comes with any investment activity. No matter how careful you are or how thoroughly you investigate a company's fundamental and financial metrics, we can never predict the future. Some of the best companies are going to end up going out of business or bankrupt. Some of the companies that appear to be in trouble now are going to end up being the cash cows of tomorrow. Unless you have psychic abilities, it is impossible to know with any certainty the future financial well-being of a company. We do know that if we pay careful attention to fundamental analysis, we set ourselves up to find companies which have proven to be successful investments. Let's give an overview of the strategies used in a long-term investment portfolio before we get started. The first strategy is called diversification. The basic point behind this strategy is to avoid putting all your eggs in one basket. Next, we are going to consider a technique called dollar cost averaging. These are the 2 main strategies that, combined with fundamental analysis and understanding of your overall goals, can lead to long-term success and wealth building. Diversification. Everyone understands the basic idea behind diversification. It is this: none of us can predict the future with any certainty, and so it is impossible to know if any individual company is going to prove to be a long-term success. Remember one of the most basic rules: given enough time, anything can happen. Companies that seem invincible today might be bankrupt in 10 years. Building wealth and income using dividend investing means that you will be looking at longer time horizons. At the very least, you will be investing for a decade. History is littered with companies that either went out of business or had to undergo major restructuring to survive over the long term. Although companies like Facebook, Apple, and Amazon seem invincible right now, none of us can know what the long-term future is for these corporations. Given this fundamental fact, an approach towards investing was developed so that rather than staking your future in one company, you would reduce your risk by investing in multiple companies simultaneously. If you invest in 20 different companies, if 1 or 2 or even 3 of these companies end up in bankruptcy, your overall investment portfolio will still remain in decent shape. This is the main principle behind this strategy. We're playing the odds that most companies that are carefully selected based on sound financial principles are going to hold up over the lifetime of our investments. Secondly, diversification is going to help you build a stock portfolio that is likely to lead to higher returns. If you take a basket of companies, some will grow faster than the average, some will be average, and others will fall behind and grow at a low average rate. Just like we can't predict which companies are going to go bankrupt, we can't know for sure which companies are going to grow rapidly over the next 20 or 30 years, and which companies are going to stagnate or even grow at a slower than average rate. Since you can't know this ahead of time, the best metric for success is to select a good number of companies to use in your portfolio. Another factor that needs to be considered is the different sectors you can invest in. Besides dealing with individual companies, entire industrial sectors are going to face different futures. Of course, it seems inevitable that technology has a bright future. That is probably the case, but looking at all the sectors in the economy, it's not certain that any one of them are going to be growing at the same rate in the future as it has been so far in the past. Remember that things are always changing in a dynamic economy. Therefore, a diversification strategy in your investments has two legs. The first leg is that you should invest in at least 15 to 20 different companies. The second leg to the diversification strategy is that you should invest in multiple sectors of the economy. So, it would be a mistake to have 20 investments in the high-tech sector. We can all agree that high-tech is not going anywhere, but that does not mean that the growth it has experienced over the past years is going to continue indefinitely. For example, we all need utilities and electricity, but most of us recognize that as far as growth, those types of companies are not ideal, but they could play a role in your dividend income portfolio. So the question is, how much diversity is necessary to have a truly diversified portfolio? One of the best answers to this question would be to invest in hundreds, if not thousands of companies, but this ideal answer has to be balanced against the realities of the human mind and how much one person who is not a full-time financial advisor can invest in truly analyzing the financial health and potential of multiple companies. There is an obvious point at which one person goes beyond their capacity to accurately make good investments. The general rule that most financial advisors stood by is a good diversification level is about 15 to 30 companies. Index and mutual fund investing. One way that you can increase the diversity of your investments is by using index funds, either for your entire portfolio or as a way to diversify part of your portfolio. There are many index funds to choose from these days, and they allow investors to spread their money around entire sectors or indexes in the economy. As we will see, you can pick funds that allow you to invest in specific sectors of the economy or large indexes such as the S&P 500. You can use funds to invest in healthcare, real estate, and other industries or sectors and gain diversified exposure to hundreds, if not thousands, of companies and investments. If you choose to go this route, the next question that follows is how many and what proportion to use. In other words, it's possible to build your portfolio with some specific investments while adding fund investments to help increase diversity. There are no exact right or wrong answers for this. What I would suggest for most people is that they should break it down 50-50. So in this case, you might pick 10 of your favorite companies that you want to invest in, and then pick a few index funds or mutual funds for the rest of your investments. That way, you will have enough diversity in your portfolio to protect you from overall risk or the risk of being too heavily invested in a single company. Dollar cost averaging. Dollar cost averaging is another technique used by experienced investors to reduce their overall risk. Let's explain how that works. What dollar cost averaging means is that you invest your money in equal amounts and over equal time intervals. The purpose of doing this is to avoid the emotional feeling attached to buying asset. Most investors try to guess when to buy and only want to buy stocks when they are trading low. With dollar cost averaging, you are buying stocks consistently in times when they are underpriced and overpriced. The benefit to using this method is your average cost to purchase these shares, and since you are buying consistently, you don't try to time the stock market. Just like how we can't predict if an individual company is going to go bankrupt in 10 years, it is difficult to say whether or not you are buying at a high price or a relatively low price at any given time, since that is not something we can know with any certainty. The truth is that if you use dollar cost averaging at some point, you will be overpaying for your stocks. However, at other times, you are going to be buying stocks at a discount. So, as we stated already, this buying high and buying low is going to average out over time. Dollar cost averaging is a simple process to implement. All you have to do to implement dollar cost averaging is to decide on a regular investment schedule. So, for example, you might decide to invest on the 15th and the 30th of every month. Then you deposit an equal amount of money in your account each time you are ready to invest. Rebalancing. Another important strategy used by long-term and income investors is called rebalancing. At the end of each year, you can examine your investment portfolio to see if it is still meeting your long-term investment goals. Securities that have outgrown your portfolio mix can be trimmed down by selling some off and reinvesting the money in stocks that need to have a larger position in your portfolio. To use a simple example, suppose that you have determined that your investment goals would be met by having a portfolio consisting of 75% dividend stocks and 25% in bonds. If the portion of your capital in dividend stocks increased to 85% and now 15% in bonds at the end of the year, the rebalancing process would involve selling off enough stocks and then buying more bonds to restore the 85%-15% balance. Rebalancing can also be used to keep your stock portfolio in the proportions that best meet your goals. So in other words, if you had Microsoft, McDonald's and Coke stock in proportions of 40-30-30, at the end of the year, they might be 50-25-25. So you would want to sell some Microsoft stock to rebalance the portfolio to 40-30-30 by buying up more stock in Coke and McDonald's. You can also use rebalancing as a time to evaluate dividend performance when you are a dividend investor. If you find that there are stocks with better yields or other properties that you would feel better meet your goals than the stocks currently in your portfolio, you can move money out of existing stocks and into these new stocks. You can also use your end-of-the-year evaluation to do analysis on dividend payments and earnings, and look for red flags, such as a company that has not increased or kept up their dividend payments. Fundamental Analysis Review. It's always good to keep up with a company's financials by reading their 10K annual report or 10Q quarterly report. You can also visit websites like Morningstar.com, SeekingAlpha.com, or ValueLine.com for a company's financials or other investors' opinions. Although we begin our investment lives excited about certain companies, there is no reason to stick with them if they deliver bad performance quarter after quarter, and they are not going to help us meet our investment goals. Therefore, you should constantly be reviewing each of your investments and be ready to make changes if a company is showing signs that it is not going to be a good investment for you over the long term. That doesn't mean you dump a company because they had one bad quarter or a bad year. You will have to carefully evaluate each situation, particularly what the company is doing to respond to a declining market share or revenues, or if they have taken on a lot of debt, figure out what they are doing about it going forward. Obviously, life has ups and downs, and some companies are going to have some bad years, but they will still be solid long-term investments that you can count on for income down the road. But there are also going to be times when it is best to sell off your investments in one company and look for greener pastures. The best investment strategy? Be active. Don't be a blind investor. Most people go about their investment lives letting someone else manage it. They get a 401k through their employment or hire a financial advisor, and then they just let things sail along. The best advice for a self-managed investor is no matter what strategy you choose to pursue, stay on top of your investments. Keep up with financial and economic news, in particular as it relates to the companies that you have chosen to invest in. Keep on top of the company's financial statements, market performance, management team, and product development and releases. And be an active investor who is not afraid to make changes when necessary. Second, never stop your financial education. Keep up with the latest books, videos, and dividend investing information. Avoid panicking. Finally, avoid panicking when investing. Novice investors always panic and sell off all their shares and move into cash at the first sign of trouble. The thing you realize about recessions and panics is that they pass with time. And when you look back at the long-term history of the stock market, you will find that the stock market declines are short-lived. As a dividend investor, you will find out that during times of stock market decline is where you are able to buy shares of stock at a discount, allowing you to reach your investment portfolio goal faster. Once you start building up a stock portfolio for dividend income down the road, you should stick to it through thick and thin and not vacate the market for cash, hoping to jump back in later. That kind of amateurish panic behavior is going to put you in a situation where you are going to be paying way too much for stocks, and you're starting all over again. Instead of taking that approach, you should use downturns to get cheap or discounted stocks. Another strategy to employ is to put a certain percentage of your investments into funds that short the market. There are a few exchange-traded funds that do this. I would not advise putting a large percentage of your portfolio into them, but 3 to 5% would be reasonable. These funds gain a lot of value when there is a recession. So, you can buy into them when times are good and then sell them when a recession hits for a major profit. You can then use these profits to buy more dividend-paying stocks when they are selling at a discounted value. Create a watch list of dividend stocks you want in your portfolio, and when the time is right, you should buy these at a discount. Here is a list of 20 dividend-paying companies who have had stellar performance in the last 10 years. T. Rowe Price Group, Incorporated. AbbVie, Inc. Realty Income Corp. 3M Co. Johnson & Johnson. Coca-Cola Company. PepsiCo, Inc. McDonald's Corp. Kimberly-Clark Corp. Lowe's Companies, Inc. Genuine Parts Company. Colgate-Palmolive Company. Nike, Inc. Unilever NV Common Stock. Illinois Toolworks, Inc. Fastenal Company. S&P Global, Inc. Clorox Co. W.P. Carey, Inc. Estee Lauder Companies, Inc. Chapter 7. Understanding Tax Implications. This part of the book is the least enjoyable, but let's face it, most of us don't know much about how our complex tax code is going to be applied when it comes to the stock market and dividends. If you're a beginning investor, that is true. The first advice that you should be given is that if you build up a large portfolio of stocks, you'll need to use a professional accountant, but having some understanding of the general rules will help as well. Ordinary versus qualified dividends. The first thing to be aware of is the difference between ordinary and qualified dividends. The kinds of dividends that we've been talking about in this book are ordinary dividends. That means that the income from them is, well, ordinary. In other words, the proceeds are taxed as ordinary income. A qualified dividend comes from a capital gain. Following the kind of investments that we have described in this book, you're probably not getting qualified dividends. Tax forms. The dividends that you get from an investment in dividend stock will be reported on Form 1099-DIV. If you are getting dividend payments from an S corporation or trust, they will be reported on a Form K-1. Note that investments in vehicles, like an MLP, will generate a K-1. Dividends that you reinvest. Unfortunately, the geniuses in Congress didn't see that it was fit to prevent this from promoting investment. However, dividends that you reinvest are still subject to tax, so you have to report any dividends that you receive on your tax return and pay taxes for ordinary income on them. Some tricks to lower your tax burden. If you have an individual retirement account, your money in the account is allowed to grow tax-free. One downside is that the wise old men of Congress limit how much you can invest in an individual retirement account to around $5,500 to $6,500 per year, depending on age. However, there is a nice trick you can use with dividends inside the individual retirement account. You can use the account to buy dividend-earning stocks. Then, when the dividends are paid, they are paid inside your IRA. That means that they are tax-free, and you can reinvest them inside the IRA. Keep in mind that when the money is taken out of your IRA after you retire, if you have a traditional IRA, you're going to have to pay taxes on it at that time. A Roth IRA means you pay taxes on the money now, but the money is tax-free later when you withdraw it. So, the procedure to avoid paying taxes on dividends is: open an IRA or use an employer retirement account like a 401k. Buy dividend stocks inside the retirement account. Reinvest the dividends inside the retirement account. That way, you won't face taxes on the dividends. The same trick can be used to massively grow your retirement accounts using covered calls. So, you buy shares inside the IRA and then sell covered calls with the IRA account. The odds are good that most of the time, the options aren't going to be exercised. So you make, say, $2,500 profit a month selling covered calls, and it's inside your IRA, and it's going to be tax-free since the account is allowed to grow tax-free. Then you use the funds from your covered calls to keep buying more shares. So, although you're only limited to putting in a relatively small amount each year after you've built up a few hundred shares, you can start earning money from selling covered calls and reinvesting the dividends. Then, when you start pulling money out of the IRA when you've retired, you will pay taxes on the money at that time. Chapter 8. Mistakes Dividend Investors Make. Dividend investing tends to attract more level-headed people. However, as a beginner, you're likely to make mistakes along the way. By learning the top mistakes that beginning investors are likely to make ahead of time, you can avoid getting into too much trouble, and maybe avoid getting into trouble altogether. In many cases, the problem with the stock market is not so much that people don't have a magic wand that lets them pick the best possible stocks, but instead, it might be people routinely make mistakes that get them into trouble. Avoid making the mistakes and let the general uptrend of the stock market take care of everything else. 1. Getting anxious to receive a dividend. The way this works out is you see a stock with a good dividend payment, and so you try to buy it as close as possible to the ex-dividend date to get paid right away. Doing this creates a situation where you can get into trouble by letting emotion start to take over. Normally, emotion isn't as much of a problem for dividend investors, but once it gets its foot in the door, you can start running into financial problems. The key to avoiding this problem is to take a long-term investing viewpoint and buy shares on a fixed and regular basis. 2. Failing to look for growth. On average, dividend investors tend to be more conservative than other types of players in the stock market. Maybe not as conservative as people who will only buy mutual funds, but more conservative than your average growth investor. The goal with dividends is to seek out mature, stable companies, but you should also get growth-oriented companies that are paying dividends into your portfolio. While they may be paying a lower dividend right now, over time, a growth-oriented company may end up paying a higher dividend than an old stalwart like Walmart or Johnson & Johnson. You will want to look at the company's history of paying dividends and see if you spot a trend, and that trend would be increasing dividend payments. Don't look at absolute amounts, look at percentages, and choose companies that raise their dividends faster than inflation. 3. Not investing in dividend ETFs. Individual stocks are fun to invest in, and people love the excitement of doing the research and being able to track all the different companies. That's great, and you can get some good buys in your portfolio. However, you should also invest some of your money into ETFs to take advantage of the massive diversification. This will also act as a hedge to help keep a part of your portfolio stable and secure. I would recommend putting between 25 to 40% of your dividend investments into 2 to 3 different ETFs, probably ones that track dividend aristocrats, and also include a REIT to diversify your exposure. 4. Not diversifying enough. We've covered a wide range of investments in this book, and you should be investing in all of them. How you allocate your investments are up to you, but strictly buying stocks might be leaving opportunities on the table. For example, there is no reason not to invest in REITs, either individually or through an ETF. You should also invest in at least 5 MLPs to take advantage of the high distributions and enjoy the tax advantages. 5. Only investing in stocks. Well, okay, we are repeating ourselves, but there are other good investment possibilities out there for income investors. You can use call options to generate income now or to magnify the impact of compound interest by reinvesting the money you get from premiums. Another investment that people oriented towards dividends should consider is investing in bonds, which can help generate more monthly income. It's not as lucrative as it once was due to the lower interest rates we've had over the past 20 years, but it can add to your income and provide some level of protection for your money. ETFs are a great way to invest in bonds and diversify beyond just investing in dividend stocks. 6. Buying stocks because they are cheap. Remember that sometimes you get what you pay for. That doesn't mean you have to buy the most expensive stocks on the market to build wealth using dividend investing, but remember, some stocks might have a low price because they are not a good investment. As we've noted before, a declining stock might try to use a high dividend payment or yield to try and attract investors who otherwise aren't all that thrilled about investing in the company. Now, sometimes a company that is set for better days in the future might have a low share price. Remember, to figure out where the company stands, you need to look at the company's fundamentals. Look to see how things are changing over time and research the company to see what new products are coming out. Sometimes a cheap stock is a bargain, but you can't go on price alone. 7. Being afraid to let go. One of the downsides of dividend investors, who by nature are going to be more conservative, is that they sometimes can't let go of a stock that isn't worth holding anymore. It can feel like you're betraying your plans when you're investing with the hope of generating a lifelong passive income from dividend payments, and the stock starts performing so badly that it's clear to the mind but not the heart you need to get out. Use the same muscles in your brain that you would use to evaluate a cheap stock you were thinking of buying and analyze the company. 8. Not taking your taxes into account. Remember, investing in the stock market isn't free, and any cash you take out is going to be taxed. You may not like it, but that's the way things go. So, it's important to be familiar with the tax laws that apply to dividend stocks, so you have an idea of what you're going to have to pay from the various profits you're making in this enterprise. You don't have to have the expertise of an accountant, but don't take the money out and say you're going to worry about the taxes later. Have some idea of what the taxes might be, and be sure to pay estimated taxes, so that you don't fall behind later and have a massive tax bill. Another concern, and this is the one I was getting to when it comes to failing to take into account taxes, is that you overestimate your profits. When you figure taxes into your transactions, you might find that your gains are not as great as you thought they were. If you are going to be building an income from dividends, it's a good idea to have an accountant, rather than trying to fly alone using tax software. 9. Not doing due diligence. The final mistake that we look at in our list is taking a cavalier attitude towards your investments. Many people don't put the time into studying the market and the companies they're investing in or want to invest in, and as a result, they don't invest nearly as well as they could. Rather than keeping abreast of what's going on, they just invest in what they feel like investing in. That could make the difference between making $26,000 a year or $75,000 a year from your investments. When you are going to buy a stock, you should be able to clearly explain to someone else the exact reasons that you would buy the stock and what you're expecting to get out of it, as far as both the dividend payments and capital appreciation of the shares. Conclusion. Now is as good as any time to begin your career as a self-directed investor. If you haven't already opened up a brokerage account, you should get on that as soon as possible. It isn't complicated, and once you take that first step, you will begin to reduce any anxiety or hesitation you are feeling about beginning your investment program. Remember that you can contribute an amount that works for you. Don't worry about the examples discussed in this book or elsewhere, or what other people are doing. Invest in an amount that is within your budget and your abilities to start investing regularly. Even if you start by only investing $50 a month, the simple fact that you are getting into the habit of running your investment program is the important thing to focus on. You can always up your contributions later. I do urge all readers to do their due diligence when it comes to investing. Beginning a process of taking control of your investments and financial future can be exhilarating, but remember that it also comes with responsibility. If you make investments and fail, the fact that you are following a self-directed and independent investment program means that if your investments fail, there is nobody to blame but yourself, but we have provided the tools you need to avoid failure. If you follow a program of diversification and dollar cost averaging, along with making regular, or at least monthly contributions, unless there is an overall economic calamity, you are not going to fail. But have realistic expectations. as far as understanding the amount of money that you can earn based on the size of your investments and the time horizons that you are going to use when building up your investments. Thank you. I would like to thank you from the bottom of my heart for coming along with me on this investing journey. There are many investing books out there, but you decided to give this one a chance. If you liked this book, then I need your help. Please take a moment to leave an honest review of this book. This feedback gives me a good understanding of the kinds of books and topics readers want to read about, and it will also give my book more visibility. Leaving a review takes less than 1 minute and is much appreciated. The end. Copyright 2020, all rights reserved. The contents of this book may not be reproduced, duplicated, or transmitted without direct written permission from the author. Under no circumstances will any legal responsibility or blame be held against the author or publisher for any reparation, damage, or monetary loss due to the information herein, either directly or indirectly. Legal notice. This book is copyright protected. This is for personal use only. You cannot amend, distribute, sell, use, quote, or paraphrase any part of the content in this book without written consent from the author. Disclaimer notice. Please note that the information contained within this document is for educational and entertainment purposes only. Every attempt has been made to provide accurate, up-to-date, and reliable information. No warranties of any kind are expressed or implied. Readers acknowledge that the author is not engaging the rendering of legal, financial, medical, or professional advice. The content of this book has been derived from various sources. Please consult a licensed professional before attempting any techniques outlined in this book. By reading this document, the reader agrees that under no circumstance is the author responsible for any losses, direct or indirect, that are incurred as a result of the use of the information contained within this document, including, but not limited to, errors, omissions, or inaccuracies. This has been Dividend Investing for Beginners and Dummies, written by Giovanni Rigters, narrated by Alex Rees. Copyright 2020 by Giovanni Rigters.